Hello students, welcome to BYJU'S IAS. Welcome to session on economy this week, wherein we'll be taking up some of the very important articles that have appeared in various business related newspapers and we'll be analyzing these particular articles. For this particular video, I've chosen the time period from 9th of March to 22nd of March 2020, and the articles that I've chosen are from Hindu, Indian Express, Business Standard, Live Mint, Business Line. Now let's begin the discussion. The first article is related to LPG subsidy. Before looking at what points have been given in the article, certain very important basic points are these. 1. India imports most of or half of its LPG requirements from the external market. So remember this, majority of it or more than 50% of the requirement of LPG in case of India, we actually import it. And when you import any commodity, obviously the price of the commodity in the international market and the variation in the exchange rate will have an impact on at what price you are going to import. For example, crude, which is the source from which we extract LPG, or this is the raw material from which we get LPG. So whenever the international prices of crude will vary, will it have an impact on the import price of crude in India? Definitely yes. And whenever the exchange rate, that is rupee against dollar, varies, will it have an impact on the value of the import for India? Definitely yes. For example, if rupee depreciates, what do you mean by rupee depreciation? It simply means to purchase 1 unit of a dollar, I am paying more amount of rupees. Let me give an example. Imagine last month I was paying 50 rupees to purchase $1. Today, if I am paying 60 rupees to purchase the same amount of a dollar, the purchasing power of rupee against the dollar has come down. This in simple terms is nothing but depreciation of one currency against another currency. And in this context, whenever rupee value depreciates, the imports become costlier for India. And in this context, whenever there is a rupee depreciation, the crude oil import becomes costly. The import of LPG becomes costly. I can understand this. So first, substantial amount of LPG that is required in the domestic market is imported. Second, any variation in the international prices of LPG will have an impact on the variation of prices in the domestic market. Third, whenever there is a variation in the exchange rate, there will be variation in the import pricing of this particular commodity. Especially when rupee depreciates, the import price of the LPG will increase. Fourth, how does the pricing of LPG is determined, or how is it determined in case of India? Government of India follows a concept called as a import parity pricing. That is, it treats as if all of these particular LPG is imported, and based on the pricing of imports, the pricing of LPG will be determined in the domestic market. Now what has happened in the recent times? Basically understand this, the lower petrol prices has led to the reduction in the LPG prices. But please understand, this particular reduction has not been transferred to the consumers. The article discusses that though the international prices have kept on declining, this is expected to provide relief to the government. In what way? Government basically subsidizes these particular fuels. Subsidizing the fuel basically here means LPG actual price is higher, but when it is supplied to the households, it is supplied at a lesser rate. Which means the difference between both these particular prices is the subsidy borne by government. Now with reduction in the international prices, the price or the import pricing parity is expected to come down. But the government is expected to provide the benefit because government has decided to increase the price of LPG by rupees 4 every month. So on one side import prices are coming, and on the other side the prices of LPG are increasing. This is expected to provide a certain financial benefit to the government in the form of what? In the form of a reduction in the subsidy expenditure. And if you see in this particular table here or graphical representation, they have provided how the subsidy expenditure over a period of time has moved. For example, for the financial year 18, the overall subsidy for both kerosene as well as LPG, because these are the two which are provided with the subsidy by the government. So the kerosene as well as LPG, in the financial year 18 incurred a subsidy of around 25,000 crore rupees. In the financial year 19, it suddenly ballooned to more than 37,000 crore rupees. And in the revised estimates for financial year 19 and 20, it has been pegged at around 33,000 plus crore rupees, but various experts have pointed out that final subsidy expenditure on kerosene as well as LPG for financial year 20 would be somewhere around 35,000 crore rupees. So these are some of the very important points which have been mentioned under this particular article. Apart from that, they have also mentioned how many cylinders are being supplied by the government, that is subsidized cylinders are supplied by the government per year to the households. The number of cylinders are 12. So just remember this particular number. UPSC might pick up a question on this in the prelims. Now based on this particular discussion, let's solve a question here. Which of the following is likely to affect the LPG prices in India? Underline the term likely to affect. So LPG prices in India will likely be affected by one, volatility in the crude prices. Is it okay? Because crude is the raw material for LPG. So volatility in this particular price of the crude obviously will have an impact on volatility of LPG prices. And since we import a substantial amount of LPG, the prices of LPG will also be affected. So first one is correct. Second, volatility in the rupee exchange rate. This will also have an impact on the LPG prices. So both option C is the right option. Second question, considering the following statements. LPG supplied for the households is exempted from GST. Wrong. LPG supplied to the households is under the ambit of GST. Please remember this particular statement. Second, India imports about half of its LPG requirement. This particular statement is correct. Right option is option B. Only second is true. Let's take up the next article, which is on a tax remission scheme. Some of the very important conceptual points are this. Government, in order to promote exports, provide tax incentives. Is it okay? In order to promote exports, provides tax incentives or tax exemptions. Very important tax incentives which are provided by the government to the exporters are MEIS. Merchandise exports from India scheme, EPCG, export promotion of capital goods, so on and so forth. Very recently, some of the other countries, that is importing countries or trade partners of India, have opposed to this particular practice of government of India providing export subsidies. The major country in this particular regard is United States of America. USA has been opposed to this particular practice of government of India providing export subsidies. It has even dragged India under WTO dispute resolution mechanism, and WTO, that is a dispute resolution body, has ruled in favor of USA and has asked government of India to withdraw these kind of export subsidy schemes or export incentive schemes. Now, in order to replace these particular schemes, government of India has proposed a new WTO compliant remission of a tax scheme by the name of RODTEP. Remember this? You will come across this in multiple newspaper articles. RODTEP stands for remission of duties and taxes on exported products. That is basically those particular goods which are being exported. On these particular goods, the taxes will be remitted. So this is a basic idea for RODTEP. Now what is given in the article? Basically understand this. Government of India has stated that this particular scheme will be implemented very soon. It has received the nod of the government of India. But more importantly, the article mentions that this particular scheme of RODTEP will be much more inclusive, will be covering many more types of taxes under its ambit. Now what do you mean by this? Understand this. Under the earlier concept of MEIS, merchandise exports from India scheme, the government used to provide the tax incentive in the form of scrips, which could be used by exporters again to get certain deductions or to reduce the tax liability in the future. But basic idea is there were certain types of taxes which were not covered under the concept of a MEIS, or in simple terms, remissions were not provided to the exporters, such as the VAT that is applicable on the fuel that is used for transportation purposes, that is the central excise and stamp duty that is applicable on such fuels used for transportation, Second, certain taxes which was imposed on the electricity were also not reimbursed under this particular MEIS scheme, or in simple terms they were not covered under this particular MEIS scheme. Now Government of India has clarified that with introduction of the new tax regime or tax incentive regime, many more types of taxes which were earlier not covered will be coming under the ambit of this particular new scheme. As a result of which, it is stated that it is going to be much more inclusive compared to the earlier regime, and very importantly, it is expected to be WTO compliant. That is, any of these particular provisions are expected not to be violating of any of the norms of WTO. And this is important for a simple reason. If this particular new scheme violates any of the norms of WTO, then any of the trading partners again can drag India to WTO dispute resolution body or dispute settlement body. Apart from this, article also mentions that with introduction of this particular scheme, Government of India is going to incur a cost of around 50,000 crore rupees in the form of tax rebates which are given under the new scheme. And much more importantly, since all the inputs or majority of the inputs which will be covered in terms of exports are given tax remission now, India is going to move towards zero taxes on inputs, or the technical term that is usually used is a zero rating. So remember this, earlier some of the inputs the remission was not provided. Now we want to provide remissions on all these particular inputs in terms of making an export or producing and exporting the commodity. And by providing the input taxes or remitting these particular input taxes, we are moving towards imposing zero taxes on imports. This is referred as a zero rating of exports. So these are some of the concepts or points discussed under this particular article. Having looked at this, let's solve a question here. Consider the following statements about RODTEP. Its coverage in terms of providing tax remissions would be higher than the ones given under MEIS. I've already told you the coverage will be much wider under this. So first one is correct. With the implementation of this, India will be moving towards a zero rating of exports. This is also correct. So both the statements are correct. Right option will be option C. And please keep your eyes open with respect to this particular term of a zero rating of exports. Why? This question can be asked individually in the prelims. For example, UPSC might give a statement such as, in recent times, the term zero rating of exports often appearing in the newspaper is related to dash. So UPSC has the tendency of asking these kind of questions. Please be very careful. Or else there could be a descriptive question in the mains asking you to write what are the different reforms which are required by the government in order to ensure there is a zero rating of exports. And please understand, you must move towards a zero rating of exports for a simple reason. If you do not provide the tax remissions or tax rebates to the manufacturer is basically going to transfer this particular tax burden on the consumer. Or to put it in simple terms, he is going to transfer the tax in the form of a higher MRP. And if you want to promote exports, if you want to promote more and more exports from India to, let's say, the foreign market or external market or into the trading partners, one of the ways is by ensuring the prices are very competitive in the market. And if you have read anything related to the exports, you must have read this also, that in the last couple of months, the exports from Indian economy have continuously been affected. There has been a problem of a growth rate in the exports. This was happening even before the pandemic, even before the outbreak of COVID-19. And the outbreak of COVID-19 has basically made it much more acute, or has made the situation much more severe. That's it. So this is the answer. Let's go to the next article related to Essential Commodities Act. Not much information has been provided in the article, but you should know about the concept of Essential Commodities Act. Now, what has happened very recently, after the onset or because of the pandemic outbreak, the Government of India has notified some of the commodities such as masks, sanitizers under the concept of Essential Commodities Act. Now, why this particular act is very important? What are the provisions? Let me explain. Essential Commodities Act of 1951 basically empowers or gives the power to the government with regards to production, distribution, supply or sale of essential commodities. I'll repeat the statement. The Essential Commodities Act of 1955 empowers or gives the power to the government to regulate the production, distribution, sale or supply or even storage of these particular commodities. But these particular commodities will have to be classified as essential commodities, notified as an essential commodity by the government. Now, why this is important? Especially in the current situation, you will understand it better. In the current situation, after this particular pandemic entered into India, you must have seen for a certain period of time, the hand gloves, masks, sanitizers were being sold in the market at a very, very exorbitant price. These were being sold at a very, very high price. So Government of India intervened and stated that the sanitizers as well as masks will be covered under the Essential Commodities Act. Under this particular Essential Commodities Act, once these are notified or covered, the sellers will have to charge a right amount of a price. That is, the price which is fair to the consumers in the market will have to be charged by these particular sellers or manufacturers. And under the powers given of this particular act, or as per the provisions of this particular act, the government can direct these particular manufacturers to increase the supply of notified commodities. This particular act usually is in discussion related to agriculture commodities. That is, whenever you discuss the concept of, let's say, the pricing of onion, usually this particular term of essential commodity or this particular act will be quoted in the discussion. Please understand, not only the discussion is relevant for this particular pandemic, even this year's economic survey has discussed related to Essential Commodities Act. The economic survey states that because of the Essential Commodities Act, the agriculture sector is suffering. Because there are certain limitations imposed by the government under this particular Essential Commodities Act, the agriculture sector is unable to identify or provide the right pricing for various commodities. That is the precise reason the economic survey argues that the Essential Commodities Act has outlived its importance. There is a need to have a relook of these particular provisions of Essential Commodities Act. But currently, understand this particular act has been utilized, and apart from this particular act, another very important act which is mentioned in various articles is this Black Marketing and Maintenance of Supplies of Essential Commodities Act of 1980. Remember this particular act also, it could be asked in UPSC prelims. Now, under the Essential Commodities Act, if Government of India says you will have to sell the produce or you will have to sell the products within this particular price range, and a seller violates the provisions of this particular Essential Commodities Act, what is the recourse? Under this particular provisions of Essential Commodities Act, government can impose penalties on the vendor. Not only this, the vendor or the supplier can even be sent to prison as per the provisions of Essential Commodities Act. And apart from this, as per the provisions of a Black Marketing and Maintenance of Supplies of Essential Commodities Act of 1980, if the vendor is violating the provisions, he can be sent for a period of up to 6 months in prison. So remember these particular terms related to this act as well as Essential Commodities Act. This could be asked in UPSC prelims. Now, in addition to this, I have also given you a descriptive question. Do you think that Essential Commodities Act has outlived its utility? Discuss 250 words. You will have to put forward certain very important points in 250 words. Now, where will you get sufficient matter to write this kind of a question? Please read this year's economic survey. In the economic survey, there is one chapter in which there is a discussion related to the concept of Essential Commodities Act itself. Now, let's look at the next article. Dollar swap window has been opened up by RBI. Before understanding what has been done by RBI, please understand, in the Indian financial market, or to be more precise, in the stock market or equity market, usually there are foreign investors who are referred as foreign portfolio investors. Some of the books or magazines will refer them to FII. Don't worry about the technical difference as of now. In this particular financial market, FIs have invested or will continue to invest. But usually what happens is this. Whenever uncertainty is created, like an uncertainty created right now because of the pandemic, the foreign investors will take out their investment. That is, they would have brought in dollars into Indian economy or Indian market, but they cannot invest dollars directly in the market. So what will they do? Convert these particular dollars into rupees and invest in the form of rupees in the Indian market. But whenever such volatility or uncertainty is created, these kind of investors would prefer to hold their investments in the domestic currency. And for them, domestic currency is what? Dollar or any other asset where the volatility is much lesser. So what will they do? When such uncertainty is created in the market, they will withdraw their investments, sell the stocks, sell the shares in the market, take the rupees, go to the forex market, sell the rupees in the forex market, purchase dollars. Can I simply say that as a result of this, rupee supply increases, dollar demand increases. I'll repeat it. As a result of this particular process where FIIs sell the shares in the stock market, take the rupees, go to the forex market, get them converted into dollars so they can withdraw these particular dollars outside India. But in the process, what has happened? They have supplied more rupees to the market. So supply of rupee increases and demand for dollar increases. Now basic economics will tell you this. Any asset or commodity whose supply increases in the market, value will come down. And any asset whose demand increases in the market, the value will increase. In simple terms, I am trying to say that based on the explanation that I have provided here, it will lead to rupee depreciation and dollar appreciation. But more importantly, what is happening? As a result of all of it, dollar volume or the supply for dollars in the Indian market, forex market is going to reduce. Now to overcome such volatility in the forex market or in the overall market, RBI has announced that it will be opening up a dollar swap window. Under this particular dollar swap window, what is RBI doing? RBI will be selling a certain amount of dollars for a fixed period of time. Understand this very carefully. RBI will be selling certain amount of dollars for a fixed period of time to a financial institution such as bank. And after the time period is over, at the same exchange rate, the bank will be returning the dollars to RBI and receiving rupees. I'll repeat the process again. In order to ensure that there are sufficient amount of dollars available in the market, what is RBI going to do? RBI will sell dollars to a bank, collect a certain amount of rupees. Let's say hypothetically $1 is equal to 50 rupees as per the auctioning conducted here under the dollar swap window or rupee dollar swap window. Now today, let's say hypothetically, I am RBI, you are a bank. I will give you $1, will collect 50 rupees from you. And I'll simply say this particular window will be open for a period of 1 year. So after 1 year, you will give me back my $1 and I will pay you rupees. Again, there's a concept of a premium here. You don't have to worry how the premium is calculated. But more importantly, the point that you need to understand is this. Dollar outflow has increased. There is a scarcity of dollars in the domestic market. Supply of dollars is lesser. RBI is trying to pump in or push in the dollars into the system by conducting a dollar swap window wherein it is trying to fight the market volatility by pushing or pumping in the swaps worth $2 billion into the system. So these are some of the very important points related to dollar swap window. Next, LTRO. Now understand this, LTRO basically stands for long-term repo operations. Now usually you have a repo operation. Under repo operation, what usually is expected? The bank, that is RBI, will be lending to financial institutions such as banks for a shorter duration. Is it okay? Usually when you read about the concept of a repo operations, reverse repo and a repo, one term that is usually associated with repo and reverse repo is short term. So understand this, generally RBI conducts operations for a short duration where it lends to the banks. This is called as a repo operations. But very recently there have been certain issues with respect to credit availability or capital availability in the market. RBI is trying to push or supply more and more capital into the system so that banks will have sufficient capital to lend at a lesser rate of interest and companies will take more loans from the banks as a result of which production is expected to increase, employment is expected to increase, supply of goods and services is expected to increase. Overall, there will be growth rate in the GDP. So we are expecting, or to be more precise, RBI expects revival of growth with these particular measures. It has reduced repo, it has reduced reverse repo, it has conducted operation twist, it has introduced many more tools such as LTRO in order to ensure that the supply of money increases in the market. Now in this particular article, we will be looking at LTRO. What has happened to LTRO and what is the basic concept of LTRO? I said in case of repo operations, RBI will lend to banks for a shorter duration. But under LTRO, remember this, long-term repo operations, RBI will be lending to banks for a period of 1 year, 3 year at repo rate. Have you understand this? Under LTRO, RBI will be lending to the banks for a period of 1 year, 3 year at a rate of interest charged, that is repo rate. What is repo rate? It is the rate of interest charged when RBI lends money to banks for a shorter duration. Generally or traditionally I am saying, repo rate stands for rate of interest charged by RBI when they lend short-term loans or give short-term loans to financial institutions such as banks. But in case of LTRO, what is RBI doing? Rather than giving loans for a shorter duration, RBI is ensuring that the loans are available for banks for a longer duration, that is at 1 year time period as well as 3 year time period, so that based on the capital that is available for 1 year as well as 3 years, the banks can borrow money from RBI at repo rate and increase their lending in the market. And when the lending in the market increases, we are expecting this particular cycle to follow. However, the third round of a repo or the latter rounds of repo have not been received very well by the banking sector. Why? There are various reasons why the banks are averse to this concept of lending. One, please understand, right now the situation in Indian economy is very risky. And the banks, in order to protect their capital, in order to ensure NPAs will not suddenly skyrocket, have become risk averse. That is, they do not want to take a higher risk by lending to companies in case or in a situation of uncertainty as well as volatility. And as such, the companies itself or themselves are finding it very difficult to conduct the business because of the disruption that has been caused in the overall economy by the COVID. The supply has got disrupted, the demand has got disrupted. Overall Indian economy is spiraling in a slowdown. In this particular situation, RBI might be trying to push this particular credit in the market. But the banks, in order to protect their own interest, have become risk averse, have not shown too much of an interest to the latter rounds of the LTRO. That has been discussed in this particular article. So these are the various articles as well as the questions related to this particular time period. Thank you. Have a good day.